here. Do a short introduction and then turn it over to our hosts for today. So thank you so much for joining us today for the third session of the Business Health Navigator for Entrepreneurs. Today's session is focused on the financial vital. My name is Daniel Anzueto. I'm happy to welcome you to today's session. If this is your first time attending one of our workshops, let me provide some context on StartOut. StartOut accelerates the growth of the LGBTQ+ community to drive our economic empowerment, building a world where every LGBTQ entrepreneur has equal access to lead, succeed, and shape the workforce of the future. I'm excited to introduce our hosts for today, Victor Gonzalez Galeano of the Personal Wellbeing Coaching Center. Victor, I'll turn it over to you.
Hey, Daniel, thank you so very much. And good afternoon, everyone. And awesome to see you. It's been fun already, and we haven't even started. So technology is great when it works, when we know how to use it. Either way, I'm happy that you're here. Our star of today is Ryan Stahl. He is sitting in Cali waiting for us. So I am not taking any more of anybody's time, Ryan. I know you have a gift to give us, so bring it on.
Great, thank you, Victor. And apologies for, I don't know how many of you signed up for last week. I had a family emergency and needed to delay. It looks like a little bit kind of an intimate setting between, looks like 4 of us right now. So we have a Q&A session. You'll essentially have kind of my time at the end of the presentation to ask me as many questions as you want. And so, to kind of start out here, what are we here for today? Really what I want for you guys after this presentation and kind of talking through my different points is I really want you to be pros at understanding kind of the building blocks of understanding the financials of your business. So, we're going to go through kind of a little more technical aspect, kind of accounting 101. I promise I've got kind of more of these different types of, GIFs, memes to keep you guys entertained and keep you focused as we go through some of that. And then some of the more relevant pieces of, reading financial statements, understanding kind of your business, and then kind of going through after that a little bit more of what I'm going to refer to as the finance side. So metrics, measuring your business, different ways to kind of get yourself to understand the success of what you're doing. So before we just begin, I'm just going to do kind of a brief, who am I? First and foremost, I just referred to myself as a dog dad. This guy here is Winston. Had him for about 5 years. Love the guy. I'm a money nerd. So originally got a master's of accounting. I transitioned into finance after doing a few years of accounting, doing consulting work and working for Big 4 accounting firms. And now I spend most of my time working in tech startups in the finance group. So the big things we're going to talk about today, kind of just accounting 101, understanding the building blocks of how we build financial statements and how we kind of, record what I refer to as kind of the micro financial events of your company. Then we're going to look at the big 3 financial statements, what to know, some examples of how to read. And then we're going to go through some metrics and benchmarks, and then kind of round it out with a Q&A. So what do I mean, and just to frame this up, when I refer to accounting and finance? In this setting, I want you to think of in a kind of a small or even large business setting. Accounting is kind of recording the economic financial events for your company. So, noting down when you make a sale, when I get cash, and then essentially compiling that data together to eventually create financial statements or just kind of other different summary reports that you may need. It's kind of a spectrum when we go from accounting to finance. Finance is heavily reliant on the outputs from an accounting team and creating the books. And essentially, my job now in the finance world is taking a lot of what the accounting team essentially does from the minutia detail day to day, aggregating that together to get a bigger picture and understanding the business. So, starting with the basics of accounting 101, anytime you record an event or a transaction, that takes place in what's called the general ledger. Each general ledger comprises of kind of debits and credits for the journal entries. And each of those debits and credits go into specific accounts. So you'll see right here, for example, we have a journal entry that was marked, January 15th, 2023. That entry affected cash and accounts receivable due to a sale. So likely in this case, someone made a sale from a customer previously, and now they've collected the cash from that customer. In the olden days, all this used to just be handwritten down on old books. Now with the advent of computers, we've gotten a lot smarter, and we have whole systems that kind of do this in an electronic format. So some of you may be kind of familiar with a little bit more small business setting called QuickBooks. This is kind of standard in what I expect for you as a small business to do, up to kind of large scale businesses called NetSuite. This one I won't expect you to be familiar with, but just kind of understanding the spectrum of how we record these different journal entries. So when we record journal entries, we really kind of have two different standards of how we record a journal entry. We have a cash basis. And so cash basis, kind of in the name in itself, we only record an entry when either cash is collected or when we spend cash. And we'll go over some examples there in a moment. This is normally kind of when you first start a business, this is probably how you're likely going to keep track of your businesses on a cash basis. It's pretty standard because it's pretty easy. You just need to track when cash goes in and out the door. The disadvantage with cash is, let's say you buy something from someone and you buy it on a credit balance, and you wait to pay someone later. Well, if I were to come in and look at your business and you're just to show me on a cash basis, I would assume that, hey, you got a lot of cash on hand, so you're great. But maybe you secretly have a bunch of outstanding liabilities to people. And in that case, if you have a bunch of credit outstanding, maybe your financial picture isn't as good. So the accrual basis essentially tries to account for that, to match the kind of economics of the business itself. And so on an accrual basis, we record sales revenue when we provide the good or service. And conversely, expenses, we record those when the good or service is received. I put a little note here, again, a little technical. Essentially what this is just saying down here, when you're legally obligated to pay someone money, we're referring to lawsuits. So hopefully you never get to that point. But if at any point in time, it seems more likely or not that you're going to have to pay someone money to essentially, because you're getting sued or something like that, that's when you would likely record an expense. So let's go over an example. a cash example of making a sale. Bob sells some donuts for a customer, and the customers can pay on credit. July 10th, Bob has a customer comes in, he buys $300 worth of donuts on credit. And then on July 12th, the customer pays Bob for those $300 worth of donuts. In a cash accounting example, what would happen is you would only make an entry on July 12th when the customer pays. In this instance, you would make an entry to cash or a debit and a credit to sales. And so what we mean by kind of just looking at debits and credits, a debit going back here to your example, a debit essentially just means a left side entry and a credit means a right side entry. And there is a relationship there, and we'll go back and cover that. But for now, you would record an increase to cash, a debit, and an increase to sales, a credit. Now, on an accrual basis, same scenario. On July 10th, we would record the sale separately from an accrual basis because we sold the donuts. We gave someone donuts. And what we would do on the debit side, the asset side, is we would record an accounts receivable. So we're just saying, hey, customer, let's call him Joe. Joe's going to owe us $300 later on here for buying $300 worth of donuts. And then on July 12th, when the customer pays for the $300 worth of donuts, we then debit the cash, which is an asset. And then we credit the accounts receivable saying, hey, Joe no longer receives, or Joe no longer owes us any money. He paid us. So let's wipe out that accounts receivable. And now we're $300 richer. Let's record that cash. Another example, going now to kind of the expense side. Paul runs a guitar shop. He buys $2,000 worth of guitars on credit from Fender. On August 20th, he receives the guitars. And on September 1st, he pays Fender $2,000. Well, Paul's running a guitar shop. So we're going to call the guitars he buys inventory. So like we did with the example for assets related to sales, we're going to debit inventory for $2,000 and we're going to credit cash because we now are $2,000 richer in Fender guitars, but we've also paid for those guitars for $2,000. So we have $2,000 less of cash. When we look at the accrual side, we're going to make, again, two entries. And so the first entry is going to be at the date we received the good. So on August 20th, we received the guitars. So we're going to debit inventory for $2,000. And we're going to credit accounts payable for $2,000, saying, hey, we got the guitars here. Those are ours now, but we owe Fender $2,000 we haven't paid yet. On September 1st, when we actually make the payment, we're going to pay, we're going to wipe out that liability because accounts payable is a liability. And then we're going to credit cash for $2,000 because we've also paid out cash. So if we bring it all together and kind of look at, well, what does this all mean when I aggregate all these entries? We're going to go to something called the trial balance. And what the trial balance is essentially an aggregation of all these journal entries together to get an understanding of what our business looks like. And so when we sum all the entries together, as you'll see here, we have debits and we have credits, and they equal the same. So they'll always net out to zero. And so that is some of kind of the importance and a little bit of the beauty behind our accounting system for both debits and credits. It's a double check to make sure hey, do I have everything recorded correctly? And did I do it right? Because if your debits don't equal your credits, then something's off. And so when we look at the general ledger and we've recorded all these entries into these accounts and aggregated together, we see we have kind of three major types of accounts: assets, liabilities, and owner's equity. And so here's the kind of what I'll call the golden formula, the magic formula, whenever you think about your business and kind of how this all kind of connects together in the way you should view the financial health of your business. Assets will always equal liabilities plus owner's equity. And so when you are running your business and when you're trying to grow your business, we want to get as many assets as possible, right? And a lot of times we want it to be cash, but the more assets we have, the more value we have. And so we can either grow our assets one or two ways. We can essentially borrow from others and they can provide us assets, whether that be cash, inventory, etc. Or we could do that by growing the business ourselves and through our own actions. So whether that's making sales, whether that's kind of, if you're starting your own business, kind of contributing your own money up front to give kind of what we'll refer to as stock or your kind of ownership in the business. Those are the things that grow assets. And your goal whenever you're trying to grow your business is essentially not only to maximize your assets, but it's to maximize the assets you've gained through your own actions, the owner's equity. And so kind of going through and understanding what these three different types of accounts are. Assets are essentially a resource with an economic value. You control it and it'll provide future benefit to you. And so cash, for example, is kind of obvious, right? You can pay for, everyone loves cash. Anyone will pay cash anytime. And if you're recording it on your books, it should be your cash. But let's say we go here to inventory, and let's go back to those guitar examples. You bought those $2,000 worth of guitars, right? And you're holding them in inventory. Let's say they get damaged. Well, it is a resource and you do control it, but if those guitars get damaged and you can't sell it, then it doesn't really have any future benefit. So it's no longer an asset. And so that's really key to understanding kind of the asset side of our business. They really need to be able to provide you some kind of future benefit in order to have value on your books. And so when we go back and think about our debits and credits on the trial balance, assets will have a natural debit balance. So at the end of the day, the sum of your assets, when you do everything right, should always be on the debit side, the left side of your trial balance. Liabilities. Liabilities essentially just means, hey, I legally owe someone money. They gave me essentially a loan of some sort. And so, some examples here we just have is like accounts payable, but you can also have bank loans, little notes payables, and hopefully never in your case, but you could have potential legal liabilities. And so these have a natural credit balance when you sum everything up at the end of the day. And then the last piece is owner's equity. Now, we essentially break down owner's equity into two different components: stock or owner's capital. So this is essentially the amount of money, potentially assets, the things you brought to the business when you started it, and other people who've decided to potentially join your business venture and say, hey, I also want to be an owner in your business. That's what we mean by stock owners and stock and owner's capital. Retained earnings, which is, you'll see the section right here, revenues, expenses. That is the sum of your financial performance from current and prior periods. And so to kind of go into even a little bit more depth here, we see that revenues here gets recorded on the right side, and our expenses gets recorded on the left side. And so what this means is, if the revenues here are greater than your expenses on the left side, you will have grown the assets here at the top. But if you have a loss and the debits here are greater than the credits, your sales, on the right side, that means you will have shrank your assets and you will have had a loss. And so owner's equity will generally have a natural credit balance, especially for those times when you contribute to the business. But for the retained earnings, sometimes you can start a business out, you'll have a few losses when you start out, and so your retained earnings will have a deficit and sometimes at the beginning of your business. But over time, as we look to grow your business, we want to make this retained earnings a credit, or essentially a positive balance. So financial statements. Now that we've kind of understood kind of how the different transactions get recorded into our financial statements, we now kind of want to bring that picture together and understand the big three. So the big three financial statements are the balance sheet. How are we doing as of a point in time? The income statement. How did we do over a period of time? And the cash flow statement. How did we just spend the actual cash? Because as we go back before, we have two different types of accounting, right? Cash and accrual basis. And so if you're doing a cash basis, really your income statement is going to be the same as your cash statement. But on the accrual basis here, because we're taking note of specific economic events of when we received a good or when we've sold a good or service, regardless of the cash, we need to provide a cash statement to those people who are going to view our business to understand kind of how we spent our money, because in our world, cash is king. Cash is important to everyone. So when we look at the balance sheet, and all three of these financial statements are compiled from that trial balance we went over before. We compile the trial balance as of a certain date. And so you can see here for Bob's Donut Shop, we're looking at the health of our business as of the 31st of January, 2020. We have assets, both current and long-term. And what we mean by that is current assets and long-term assets are listed in order of liquidity. So cash is the most liquid. You can spend cash on anything. Accounts receivable, second most liquid. Hopefully I'm going to collect something from my customer. And then as we go down here, these things get harder and harder to convert back to cash. And that's how we list the order on our balance sheet. Liabilities kind of follows a similar pattern. So we list the liabilities we have to pay off first. Accounts payable are vendors who maybe we buy for Bob's Donuts flour from like a grocery store on credit. We're gonna have to pay pretty quickly, down to what listed here is long-term liabilities, which would be things like a notes payable paid over 10 years to a bank, maybe a loan for our donut shop right here because we have some renovations and improvements for our store, and we bought, and we essentially needed to lend some money in order to kind of improve our store for our customers, down to owner's equity. And so what you'll see here, kind of looking through Bob's donut shop, he has a pretty healthy amount of cash on hand. He'll probably be okay. He has some inventory, probably some flour, some sugar, things like that to make donuts. And he's likely, kind of bought all of the flour from the money he contributed to the business. But kind of interestingly enough, if we look here at retained earnings, we see a negative amount. And so what that tells me, just looking at this balance sheet, is Bob's probably not quite profitable yet. He hasn't had, over the existence of his business, he hasn't quite turned a profit yet. But we're confident Bob will get there, and that's okay. So let's look at a little bit more of a complex example, because Bob's is a pretty simple situation. But let's say you want to look at a business, and you run whatever business, and you want to look at a public business just to understand how you compare to other people. Well, Apple's big balance sheet is long and lengthy. Good luck understanding it unless you've had several years of working in finance and has spent a lot of time reading these. But that's okay. I'm here. We can kind of go through some time and understand the big key points. So cash and cash equivalents. Let's back up actually for a moment. Whenever you see these financial statements, a lot of times, especially for public companies, we will compare 2 periods of time. And for Apple, they have a fiscal calendar year, which essentially just means they will report their financial statements generally on September. And so when we look at this in September, Apple in 2019 had more cash on hand in 2019 and less cash on hand in 2020, which is pretty interesting. We can also see, their debts, their current liabilities haven't really changed much. That's kind of boring. It looks like here on the non-current liability side, they maybe took out some loans. But, and here's something most people wouldn't get without doing some research. We can see here their retained earnings shrank from 2019 to 2020, which is like, well, we shrank about from 45, and this is in millions, so $45 million to $15 million in retained earnings. What happened there? Well, our cash didn't decrease that much, so it couldn't have been that. And so what had happened in 2020 is Apple did something called a stock buyback. And so essentially Apple spent a bunch of money because they're like, hey, I think the market has undervalued my stock. I want to increase my stock price. Let me pay essentially $50 billion to get all these stocks. And so Apple paid a lot of money to essentially buy back a bunch of stocks. And so this is why you see this decrease in retained earnings over time, because anytime you buy back ownership from someone else, you reduce your retained earnings because you're also sending cash out the door. All right, the income statement. So the income statement is purely the changes to retained earnings for a certain period of time. And so when I take my trial balance, and this is for 1 month, this is for 1 month ending January 31st, I'm going to take the retained earnings piece of my trial balance as of December 31st, 2020. And I'm going to take the difference from that for January 31st, 2020. And so when you think of an income statement, remember, it's the change, essentially the changes to your trial balance, the change to the health of your business over time. So how well did you do? And essentially growing that piece of the asset pie and your owner's equity by running your business. When at the end of the day, the big important number we look at is net income. And so net income essentially just means what's the difference between what you sold and what you spent. Looking at this example from Bob's business, he got $3,600 in sales, great, but he spent a lot of money, especially on supplies and wages for his donut business. So not so great. Bob's got some work to do. He's going to need to figure out how to essentially bring down costs or increase the sale price of his donuts in order to make a profit. When we get into kind of a more mature business, people will want to understand essentially the breakdown of your costs. And so when we look at our business, we're gonna essentially break it down into two big pieces. Our cost of goods sold, our cost of revenue side. This is essentially a section here just to understand the cost it takes to sell our product. And then the operating expense side. And so think of this as overhead. So these are the costs to essentially run the selling of your product and your business as a whole. When we get down from there, from our operating expenses, we get to some other expenses here. We're not going to go into depth on those. Things like interest expense, maybe you, for some reason, have invested in stocks for your business. And those will go into this line called other income. Those are other small expenses that aren't really part of the major operations of your business, but they affect your business nonetheless. And so expanding on our COGS section, our cost of goods sold, cost of revenue, cost of sales, different flavors, different names, same thing. Our cost of goods sold is, essentially just the cost of providing or making our product or service. So things like this include raw materials, labor, hosting fees if you're a software business. And once we get down to those different costs and essentially subtract them from our revenue, what we're left is the gross margin. And so a good way to think of gross margin is that the gross margin is essentially the value we provided to our customer for running our business. So if you're Bob's Donut Shop, for example, and you had made $50 worth of gross margin from $100 of sales, what essentially you're saying is, I, Bob, have provided essentially $50 of value after selling all these goods for the remainder running of my business. And we look at this number very closely because if you don't have a lot of gross margin, so if your product is very costly to make, or if you just haven't priced your product well and are not recouping your costs to sell the product, that means in order to kind of have a viable business, you either need to raise your prices or reduce your costs before even thinking about selling this product. When we move on from the gross margin, we now go to operating expense. And this is essentially the cost of kind of developing and selling your product as well as running the business. And we really break it down into three distinct categories. Sales and marketing. These are the people who are going to sell for you. Those are the people who are bringing customers in. Research and development. These are the people who are making the product. You may or may not have these functions, or you may. And then general and administrative. So that's just everyone else. So the people like me in finance, your legal team, potentially your HR team, these are your G&A people. And these are the people who are just making sure your day-to-day operations of your business run smoothly and can be successful. And so when we go from gross profit, and essentially, excuse me, I have a typo here. What we are doing is, let's see here. There we go. So operating income is rev minus COGS minus OPEX. And this will get you to your operating income or loss. And so what we're saying is here, after the normal course of your business day to day, after you subtract the sales, the cost to make your product, and the cost to run your business, this is what you're left over with before all those kind of other potential tiny expenses to run your business. And so if we kind of, skipping ahead here, net income, if we kind of look here at this example I provided you of this random software company called CrowdStrike. Let's look kind of section by section. First, we have the revenue section. Whenever, again, we look at kind of a public company or really any kind of business, we kind of want to compare over a period of time. In this case, we have 3 different fiscal years. And so their fiscal year ends January 31st. So the period of the income statement we are looking at is essentially December 1st to January 31st. And so in 2020, they had, looks like we're in thousands, they had $481 million worth of sales. Pretty good. I don't know if I'll ever get a business like that one day, but that's pretty impressive. And we go over to 2022, and we have, wow, about 1 billion in sales. That's a huge increase. Kind of having already done some back of the napkin math here, this was about a 210% increase from 2020 to 2022. Pretty impressive. If I look at our cost of revenues, they've gone up kind of proportionately, but I'm going to go ahead and skip down to kind of the more interesting part and look at our gross profit. And so this is the money we had left over after selling our product. This increased, I think it was about 220%. So, not only did we increase our sales, but we did it really efficiently. We essentially lowered the amount it takes to provide our service or a good and got even more gross profit at the end of the day. But the picture changes when we look down here at operating expenses. And so let's skip real quick down to loss of operations. You can see here in 2020, it was $146 million loss. Really big. We look in 2021, hey, we reduced that loss. We're a little bit better. We're still kind of losing, but making some progress. And then back to loss. Back to a loss almost similar to 2020. Even though, hey, we increased this piece of the pie quite a lot. What is that telling me? Well, if I go down here and I kind of just look at these numbers, I look at them, I'm like, wow, it's a big increase. And if I do some quick maths, our operating expenses increased by, and excuse my terrible handwriting here, 250%. So our overhead, we increased by way more than our gross profit increase of 210%. That means at the end of the day, we went back up from our loss of operations. Some people may think that's okay, depending on where you are in the business. A lot of people will be like, you got some work to do. You need to figure out how to get better here in this section and reduce the overhead of your business in order to essentially maximize this number again for your net income, net loss in this situation. So when we look at it and we try to bring this picture together, this is kind of how you should view it. We start from revenues. We subtract out our cost of goods. We subtract out our operating expenses. We subtract out these random things that don't really pertain to running our day-to-day business, but affect us, like taxes, interest, other miscellaneous regulatory expenses. And we get to the amount of money we're left over. All right, now onto the cash flow statement. So for the cash flow statement, again, it's all about the money. We want to understand, hey, how did I spend my cash? And we really break it down into 3 categories. We break it into operating activities. This is just, hey, how did I run my day-to-day business? What was the cash involved in doing that? We look at investing activities. So what money did I gain or use by kind of buying and selling assets? And that can include things like, if you're Bob's Donuts, I wouldn't necessarily be manufacturing, but maybe some big cooking equipment. Or if, you have an office, you just opened up and you want some furniture, maybe I bought some furniture. Another one, if you get big enough one day and you take all my lessons and become a millionaire and, give me a little bit of kickback and I have my own company. If you buy Ryan's company, that's also essentially an investing activity. And then the last piece is the financing activity. And so kind of thinking about it, financing activity is going to be, hey, what's the cash for essentially starting your business that you contributed? So owner's equity. And maybe you bring in new investors. That's also owner's equity. Or on the liability side, maybe you take out a bank loan. And that's also a financing activity. And so kind of going over here and looking at our cash flow statement, investing activities and financing activities are naturally kind of intuitive. And so you can look here and you say, hey, I sold some fixed assets. Fixed assets just means I sold some equipment, whether that be cooking equipment for Bob's example. Maybe I have a big tractor because I'm a farmer. I sold off an old tractor and I got some money from that, as well as purchases from those you may have made. And the cash left, we always look at this at net cash. So the additions, the inflows minus the outflows gives us the net cash. Here it says net cash provided, but it's a negative. So this is net cash used. For financing activities, we got a long-term loan, probably from a bank, maybe to buy, this piece of equipment right here. Those dollar amounts look pretty similar. And then the operating activities. So this is where it gets a little complicated. And this is where I will always tell you 99% of the time, you're just going to look at this line here below. Skip this stuff up here. It's hard to understand. If you are really interested, you get to become a guru, you'll kind of understand why this is. And kind of here is my way of helping you bridge that a little bit. So essentially in the finance accounting world, we have two ways of compiling this financial statement. We have a direct method. This is more descriptive, but a lot more difficult to come up with, because essentially what we have to do is we have to look back through our long list of potential general ledger transactions and say, all right, how much cash should I get from collecting from customers? You know, how much cash should I get from essentially selling product or buying inventory, et cetera, et cetera. And that can be quite a lengthy and difficult process. Versus the more common and easier method of compiling cash flow, which is just some basic algebra, is essentially taking your final retained earnings number, which again, remember, the changes to net income as it changes to retained earnings, removing out some items that are non-cash items, and then also accounting for some of the changes on your balance sheet to get to your operating activities. Looking at these components individually on an indirect method may give you some information, but you will have had to spend a lot of time, like me, really understanding what it does and doesn't mean. The direct method, on the other hand, gives you a lot more information, but unfortunately, you just are likely to never see it. So that's why I say, whenever you're put into a situation like this and you have a big complex cash flow statement, for net cash from operations, this is the money you got from just running your business. I always say just skip to this bottom line. Don't bother with the stuff up here unless you feel real comfortable and you think you can get something out of it. And then for the other two areas, you can look here and you can kind of get some intuitive explanations. For example, here we have repayments of debt. We have, we issued some common stock and paid out some dividends. We sold some things here and here. All these will be kind of descriptive and kind of help you understand, versus when you're trying to understand these changes in what they call operating assets and liabilities, it's a little more complex. Okay, so kind of on to our final section, metrics and benchmarks. Metrics and benchmarks are, kind of dumbing down this bland explanation. It's essentially ways to measure your business so you can compare it to either how you're doing, how someone else is doing, or how the people in the industry you work in as a whole, a bunch of businesses, are doing compared to you. And so when we think of metrics and benchmarks, we really break it down into kind of three categories. First, we look at growth. So how am I essentially growing my business? And the things you are going to really care about growing are your sales and your profits. So things that I can look at in my business for growth are maybe year-over-year revenue growth. So essentially, let's say I had 150 in the current year, this year, but in the prior year, I had 100 in sales. So I grew my business by 50%. That's a good metric. Some other metrics here. lifetime customer value. That's just a metric essentially taking the average sales a customer provides and multiplying it by the amount of time a customer will spend money on you. So like, let's look at a Apple Music subscription. And let's say a customer, is going to spend about $10 a month, and they stay with you on for 2 years. So that's 240 months. So the value of that customer to you is $2,400. So that's that could be a hypothetical lifetime value of a customer. Another one is total addressable market. This one is a little bit more high level. It's a little bit more nuanced, but essentially what you're trying to get to is, what is the total opportunity? What's the total dollars available to me for people who will buy my product? When I look at expenses, efficiency, things I'm going to look at here are potentially gross margin percentage. So if I go back and I look at my income statement, that's essentially our gross profit divided by revenue. And the reason we come up with a percent is you could have $1,000 worth of sales and get 200, so that's 20%. Or you could only have $100 worth of sales and have a gross margin of 30. But now you have 30% gross margin. So I look at these two businesses, I'm going to say, well, yeah, their sales aren't as good, but they're clearly making more money at the end of the day left over in the pie because they have a 30% gross margin. And then kind of the last section of metrics I'm going to call is liquidity. So essentially, this is just saying, hey, how much essentially, and this is usually cash, but how many assets, what's our comparison of assets to debts? And what we're trying to say here is, if I owe money to people, how likely am I able to pay that debt off and still have money left over? And I'll say probably the most common and a little bit more important, I'll go over that a little bit in the next slide, is your cash burn runway. And so essentially, this is just the amount of cash you have on hand divided by your monthly expenses. And let's say I have $100 of cash on hand. I have $20 in monthly expenses. That'll give me 5 months of runway. If I were to essentially not make any more money and I'm just burning cash month over month, I have essentially 5 months of runway before my business is out of cash. So when I take that all together, and here's your Ryan's go-to guide, because every business is different. Every business is going to have different kind of key metrics and key benchmarks to focus on. I'll say the ones you should care about most are your year-over-year sales growth. That's going to tell you how you're growing your sales and how you're growing your business over time. This is usually denoted as a percentage. Your gross margins, and I'd say probably not only in dollars, but also as a percent. This is something called the customer acquisition payback period. And so what this just means is, what are the costs of my sales and marketing team to acquire a customer divided by my revenue in order to understand how quickly I get paid back from bringing them into my business. Next is days sales outstanding. This is essentially a collections metric. And what we're trying to measure here is how quickly can I get money from my customer? The quicker you can get money from your customer, the better, because we always want cash. Again, cash burn runway, we already went over that. Or operating income. Operating income again, it's like how much money do I have left over after I ran the normal operations of my business? Some of you may have this, some of you may not, but as you get to be a little bit bigger company and you take on debt, something called the interest coverage ratio. So essentially, that's the amount of income you make in a month divided by the amount of interest you pay in a month to assess how much money do I have left over to pay off kind of my interest obligations, to make sure, I don't get dinged by the bank and they come after me. And then the big one, everyone's favorite, net income. How much money do I have left at the end of the day? Unfortunately, just kind of given the nature of these metrics and benchmarks, they are a little bit hard to find. I can tell you guys, as a finance professional, a lot of my understandings in the industry, I have all these benchmarks and metrics I've come up with for my business. I've just understand because I've gotten exposure and I've worked with a lot of people who look at this. But my secret, whenever I have a question on anything, is to go to Google. So a lot of times maybe you'll go gross margin, SaaS benchmarks, and it takes unfortunately just takes a little bit of digging, but you'll find a lot of people who kind of write articles and explain what a good SaaS metric is. And so let's say for software, for example, kind of the industry standard is you want to make around 70 to 85% gross margin. Everyone is going to have their own opinion on these benchmarks, but these comparisons over time really kind of inform you how you're doing and how you're doing against your peers with the success of your business. And so kind of with that, guys, thank you for sticking here with me through all this. Let's see if I can find the Zoom again to share my screen. I think we've got about 20 minutes left. Just kind of open up some time here for potentially any Q&As you guys may have.
Fantastic, Ryan. Thank you so much. For folks that are on the call, if you would like to unmute, you can ask questions. You can also drop them in the chat and we'll go through there. Ryan, I just wanted to say thank you so much for this. I am not a financial person and used to run a nonprofit and had to learn how all of these things work on the spot. So I appreciate you sharing these things. I think some of the insights that you shared as you were going through the balance sheets and showing kind of the differences is you can really learn a lot about a company and how they're being managed, what their history, track record looks like, even future forecasting based on some of these statements, which at least on the nonprofit side that I was on are readily available. These spaces you can just go up and look at person's 990 or look at their P&Ls and kind of look at that. And so I appreciate that. I think it's super helpful. One, you should know it for your company, but knowing just how it works gives you so much access to information that I wasn't aware of before.
Daniel, thank you for your comments. I'll jump in because Ryan, thank you for bringing me back to high school. It's been a minute. We were talking about COGS. I made me a note. I had to say that. My experience is in retail banking for 25 years. I'm supposed to know anything and everything about the numbers. I know I'm not the guy for the numbers. So I do appreciate you sharing the gift, because the reality is when you talk about the S&Ms and the R&Ds and the G&As, those people are me in my business.
Mm-hmm.
So I will imagine that it's the same thing for some of the solopreneurs and entrepreneurs in our audience. I don't know about Preciosa, but I know that Jason has a business going on in New Jersey, and he's looking forward to establishing it in Florida. So having these roadmap sort of like laid out in such way, then that way I know that if I'm going to be starting with the basics, balance sheet, income statement, and cash flow are the stops that I gotta make on that road. Everything else is awesome. And hey, Ryan, how do you do this? Because I'm not interested in learning. So that's your gift, not mine. So, but balance sheet, income statement, and cash flow is what I'm taking away, that I know I can do a better job when it comes to my business. Jason, are you in a position to ask a question?
Hopefully you guys can hear me. I'm sorry, I'm very sick, so I'm laying down as I learn this. I mean, mostly for the most part, it's just I have to have the stuff ready for the accountant because the numbers are just way too big for me to really focus on trying to figure out exactly who's paying what and what goes where. So that's why luckily I have an accountant doing that for me. But as far as real estate, some of this goes towards it, but not completely, if that makes sense. Like I don't have like the sales are not like, you know, what am I paying out except for marketing? So
Sure. And I think, and that's the thing with these at the end of the day, it's different for every business. And so
yeah,
we kind of go back here and let's apply your business to kind of this dummy P&L example. So
yeah,
the revenues you're going to make is your commissions, right?
Mhm.
The fee you charge for the service you provide.
Correct.
And then your expenses, whether it be this simple or this complex,
Yeah,
is just going to be, you know, essentially depending on how you want to view it. You could be paying yourself a salary. You could be paying for marketing expenses for your business to grow and get new clients. And then kind of that money you have at the end of the day, net income, will be the additional money you have left to reinvest in your business and try to, again, grow this kind of top line piece of the pie.
yeah. See, and it's two different types of businesses, so it's tough. One is very simple like this, the other one is very complicated. So that's why I do, you know, I have to have an accountant. Victor and I have had that.
Well, and Jason, I don't expect you to go through and make these journal entries yourself. I expect you to have an accountant who does this kinds of things for you. But what's important is if your accountant provides you this and you're like, well, what is gross profit and what is this? You know, it's important to kind of have this foundation. So you can not only just understand this very bottom number, which, you know, is the most important piece of the pie, but to kind of also understand, hey, like, what are the things I'm spending most on that, you know, I could tweak, you know, improve this bottom line number? Because looking at, again, at this example, like these people increase their overhead a bunch, but they're losing a bunch of money. So I'd go back to them and be like, yo, like, this is great. You're doing stellar up here. You don't need to try to figure out how to spend less money on selling your product. You need to figure out how to kind of maybe cut out the Victors and me's of the world here from your business and use less of that. And so those are some of the distinctions,
The good
whether
thing,
you're here or there.
yeah, the good thing is that you went over everything that I understand. When he hands me these things, I know what I'm looking at.
Yeah.
Because first I was like, I have no idea what you're giving me, but okay, you know, it sounds good. As long as this number's at the bottom, it sounds great. But I didn't know what any of that was, you know. So you really went over it, and I understand it a lot better now. So that's a good thing.
Hey, Jason, thank you. And
You.
it's great to hear that you're getting a greater value than you thought that you were gonna get.
Oh, absolutely, yes.
Coming to the presentation, and you bring up an excellent point, which I'm gonna put Ryan on the spot, which is, hey, this is all great, and I can understand it a little better, but at the end of the day, I need you. So
Mhm.
some of us already have our accountants. In your humble opinion, what are some of the things that we should be looking for when it comes to choosing an accountant, somebody that is going to be running our business or businesses, like in Jason's case?
Yeah, I mean, I think first and foremost, you always kind of want to look a little bit for that gold standard. You know, you want someone who has a CPA, and when someone's compiling these things for you, what a CPA just means is they've taken a greater length at their education, as well as kind of, I'll tell you, it's a really complicated test to show their extensive knowledge that they have a full understanding of these nuances. Because, you know, you can always, like we said before, do, you know, these cash side entries, and you'll do okay. Anyone can do that. That's not hard, right? If I spend $300, I get rid of it. But the thing is, most people in the world are going to do this accrual side, and the nuances of that takes a lot of either formal education and or just experience, having worked in this world, to, you know, make these entries appropriately, so that when you go to, let's say, someone, either a new potential business partner, or even a bank to get a loan, they're going to want to hopefully see this, so they can understand the bigger picture of your business, which they're going to look at this balance sheet side of things, right? And really understand the health of your business, because in a cash side world, you don't have this. You may have some of this. You're not going to have any of these things or these things. And so if someone can't understand who you owe money to and how you spent your money, they're just not going to want to invest in you.
Awesome. Well, Ryan, thank you. I know it's a lot of information for some of us that are not as numbers driven. And I've said it to you before, I'll say it again. That's your gift, your superpower. So thank you for sharing it with us. I wanted to, are there any other questions or anything else before I move forward?
I'm good, thank you.
All right, Brian, thank you. So here, what is coming up next in our journey of Business Health Navigator? So you guys can see my screen, right? Yes.
Yes.
All right, fantabulous. So Business Health Navigator, what's coming up next? It's legal. It's on July 2nd. So sign up for that. Here's the deal. We're on this journey of A to the 5th power. A1 for awareness, A2 for awakening, A3 for attitude change, A4 for action, A5 for accountability. And Jason, you just said you just got an awakening because now you see the numbers or the reports in a different way based on what Brian was able to share with us today. But that is not going to do anything unless you have an attitude change and take action. And so don't have to answer, but what will you be doing differently going forward when it comes to getting these reports for your accountant that is going to help you better understand and then elevate your business performance to the next level? The accountability remains on you. I'll be your accountability partner. Nonetheless, it will be you. So what is next? Legal, July 2nd, marketing, July 23rd, strategy vital, August 13th, and then we'll have a final summit closing of the program on September 10th. Until then, have a fantabulous Pride Month. Continue to enjoy yourselves and be well. I know that the summit is coming up for StartOut. It's going to be on LinkedIn. So headquarters. So Daniel, have an awesome time. Back to you.
Fantastic. Thank you all so much, Ryan. Thank again so much for your time today. In the chat is a link for the other sessions, as Victor mentioned, if you would like to sign up. But thank you all so much. We'll have the recording out to everybody in a few days. Thanks so much. Have a great day.
Have a good day,
everyone.
Daniel. Bye for now.